So, welcome to today's webinar. It's going to be all about Brightpearl's multi-currency accounting feature. I'll try and keep it to about 30 minutes, and if you've got questions as you go along, pop them in the questions box in the GoToWebinar control panel, and I'll try and get to them during the session, otherwise I'll get to you at the end or perhaps afterwards. Okie dokie. So, Brightpearl multi-currency accounting. What we're going to cover today is the core concepts of multi-currency accounting in Brightpearl. We're going to look at banking in different currencies, foreign debt, so that's accounting of course, and the payment allocation for that foreign debt, customers and suppliers, and then selling and buying, which is orders. This is the first of two webinars. This one introduces the functionality of the accounting, and the second webinar in a couple of weeks' time introduces you to the transition. So if you're already using Brightpearl accounting, how you're going to switch to multi-currency. So what is multi-currency accounting? The main difference that we've introduced over prior versions of Brightpearl is that you can now account for a journal in different currencies. And an accounting journal includes banking transactions and customer and supplier invoices. Brightpearl's always supported foreign currency orders, but the accounting, in other words the payments for those orders, has always just been in your base currency. So let's drop in and we'll tackle some core concepts. Where previously an accounting journal had just the base currency amounts, the debits and credits, accounting journals in Brightpearl now have transaction debits and credits. And excuse me if I'm dropping in a little bit advanced here, we're assuming that Brightpearl users or webinar attendees have got a certain level of knowledge of Brightpearl accounting. So the new journal has got the transaction debit and the transaction credit, which is in the account currency. It's also got the currency and the exchange rate. So that's a pretty straightforward change. You can see here that this is a $150 journal at a rate of 1.5, converts to 100 of whatever my base currency happens to be. So bank accounts is the first thing you'd probably notice having a foreign currency. All of your bank accounts must be assigned a currency. You won't see this unless multi-currency is activated on your account, and all of your existing bank accounts in Brightpearl will have been assigned to your base currency. Even if they represent one of your foreign bank accounts, the actual numbers in there are base currency. So if a bank account is in a foreign currency, then all of the journals involving that bank account must also be in that currency. So that's just something to remember. Foreign banking, foreign currency journals. If a bank account's in base currency, then any journals for that currency, for that bank account, can be in any currency. And there's a bit of an explanation there underneath. You can have a look at that later if you need. But this is just a rule that's worth bearing in mind throughout the training and throughout your usage of Brightpearl multi-currency. So bank accounts are given a currency, but no other nominal codes are given a currency. And that's because the other nominal codes are the other half of the double entry bookkeeping journal. So here's a bank transaction against my dollar bank account for sales. And the same sales code, 4000, could be used for a euro bank account or a yen bank account, and therefore it needs to accept transactions in any currency. The dollar bank, however, must only see dollar currency transactions. So let's drop into Brightpearl and we'll see this in action. Let's have a look first at the list of our bank accounts, whereby previously they were all in one currency, but now, because I've actually turned multi-currency on for this account, I can choose the currency of that bank account. Once the bank account has had transactions, you can't change the currency. So we've got no balances in any of our foreign bank accounts. We'll only have a small amount of balance in our base currency bank account at the moment. So let's just receive some money in to a foreign currency bank account. We'll choose dollars. It'll show us that we're actually receiving this in dollars, and let's just say this is going to be a dollar loan. We choose the exchange rate, and I'll come back to where that comes from later in the webinar. And of course it's not rated as a loan, and let's put $10,000 in there. Enter a receipt. We now go across to our bank account list. You can see that we've got $10,000 in that bank account, and there's a sterling balance of just under 6,000. Let's go to the general ledger where we can see this new type of journal, where the debit and credit are the transaction debit and credit, in other words, in the currency of the transaction, and they've also got a base debit and a base credit and the rate. So that base value is snapshotted at that point in time, and you can revalue the base equivalents of your foreign currency amounts at any time in the future. And I'll come back to bank revaluation shortly. Okay, so that's receiving money into a foreign bank account. What we're now going to do is just transfer it into a base currency bank account. We'll go accounting, bank transfer, from our foreign bank account to a base bank account. And we'll go transfer half of that, and we could choose a different rate. So say the bank had only given us 1.54. You can see I haven't updated these rates for the past couple of weeks at this dollar to sterling rate. Enter the bank transfer. And there we go. Recent transfers shown on the right. At this point, it's worth me introducing the fact that everything is relative to your base bank account. So you could transfer from a base to a foreign, or a foreign to a base, but you can't transfer from a foreign to a different foreign. So you couldn't transfer from dollars to euros, for example, because Brightpearl doesn't store the exchange rate between those two foreign bank accounts. You can, of course, transfer dollar to dollar or euro to euro if you wanted. So PayPal is not like other bank accounts, because PayPal actually retains the foreign currency value of the money within PayPal, and it only converts to base upon your request. So what we suggest in Brightpearl is you actually create a separate bank account in Brightpearl for each of your PayPal currencies. So you can retain the equivalent value in your Brightpearl system as is shown on your Brightpearl account. And here's a little screenshot of the payment methods. So you can set up for each of your currencies the relevant bank account for that particular currency. And I'll come back to payment methods and orders later, but this is just a quick introduction to PayPal being different. Here you can see what it would look like if you've actually got multiple PayPal accounts in your bank account listing screen, whereby the dollar PayPal account shows 100 minus 100, and the euro shows 263. Now, we don't actually have a dollar balance in PayPal, but we do have a euro balance in PayPal, and it shows the actual currency balance in the system here if you're connected to Brightpearl. Sorry, if you're connected to PayPal. So that's a quick overview of banking. There's obviously more stuff in the box, but we are only covering most of it in the webinar. We're going to move on to foreign customer debt now. So that's quick invoices and credits, as well as sales orders and sales credits. In a very similar way, you've got the transaction amounts and the base amounts, the currency and the rate. Contacts can have balances in any currency. So we don't enforce a customer to be a dollar customer, or we don't enforce them to be a euro customer. Each invoice can be a different currency, and those invoices will build up balances on that contact in all of the different currencies. So there's a question coming in here. Back on the bank accounts, if you wanted to transfer euro to dollar, in other words foreign to foreign, you'd have to move it through what we'd call a contra or transfer account, which is just a temporary bank account for you to handle the exchange rates as you see fit. So here you can see the multiple balances for this particular contact. And when a contact has multiple currencies, the payment allocation and the creation of statements for those customers is done on a per currency basis. So you choose the currency and then you allocate the payment, or vice versa. But from here you can easily see the balances that your contact has. Another really important rule to remember is all of the journals for a given invoice or credit need all to be in the same currency. So if you invoice in dollars, you've got to pay that in dollars. Or if you prepay an order in dollars, the subsequent invoice will automatically be in dollars from Brightpearl. So what we're going to do is quickly drop across to the demo account and have a look at how it works. I'm going to go with a quick invoice first. I'm going to choose a dollar customer, and because I've assigned currency of dollars to the dollar customer, the screen just suggests that I want to enter a dollar invoice. I could, if I wanted, enter a euro or a sterling invoice for this particular customer, just on this instance if I wanted to. And let's say this is a $100 invoice. And let's also choose the dollar customer again, and this time we'll just choose a euro, and it's going to bring in the euro exchange rate. Let's say it's 10 euros. So that's how you enter foreign currency quick invoices. If we go down to the general ledger now, you'll see we've got 2 sales invoices in 2 different currencies for the same customer. Clicking to filter by that customer and going to the accounting tab, you can see this contact has got balances in all 3 of my currencies. So we've added a couple of currencies. What we're now going to do is move on to the accounts receivable or debtors screen to see how all this works on a company-wide basis. So let's go customers, age debtors, and there's only one row on here. Now that's because all of those foreign debts have got a base component. In other words, the base columns, they will add up to 14 minus 1431. The reason being we only show base currency here is because the total of your debtors needs to match the balance on the balance sheet. So the base component of all of your debt matches your management reports. Management reports are all in base currency. So that is your profit and loss, your balance sheet, and your trial balance. So here we can see that the base value of my debtors control account is minus 1431. It's made up of various foreign currency transactions, but the base value is minus 1431. So let's say we actually wanted to take payment from this customer. We can see all of our foreign debt in, let's say, sterling, dollars, or euros, and filter. And here we now have the age debtors of only my euro debt, and we can drop into the allocate payment. And we only see this particular customer's euro debt on this screen. Pretty straightforward so far, I hope. Now, we may or may not have a euro bank account. Let's first of all take the scenario where we don't have a euro bank account. We've invoiced them in euros, but they're going to pay us, and our sterling bank account is just going to reflect a certain amount. So here we can choose only our base currency or our euro bank accounts. Because it's a foreign currency, we can't pay it with another foreign currency, so I can't pay a euro invoice with dollars. So base currency bank account, if we pay it in full, we're going to be receiving 826 sterling. If your bank's converting this to a different amount, they'll give you an exchange rate, which you can put in here. And then it's simply a case of clearing that invoice. Let's go to the general ledger, and you can see the sales receipt for that sales invoice is also in euros. So let's just roll on my slides. So far, we've been creating invoices and paying invoices with the same exchange rate. So that's pretty straightforward. However, exchange rates in the real world change all the time. So I'm going to introduce the exchange rate variance journal. Let's take a simple foreign invoice for 150 euros. The base component of this is 100. We then pay that sales invoice with a sales receipt. Again, 150 euros, but a different exchange rate this time, because it was paid at a different time from when it was invoiced. If we just look at the transaction columns, the dollar or euro columns, you can see that this invoice is paid. But if we look at the base columns, there's a balance left over, 714, what we need to do to also clear the base columns is write off that 714. And what we've got here is a further journal, which is a sales receipt or a purchase payment for supplier side of things, against the exchange rate variance nominal code. This means that the total of the transaction columns and the total of the base columns will add up to 0 and the invoice is fully cleared. So the exchange rate variance journal has no transaction amounts and an exchange rate of 0. Exchange rate variance journals like these are created automatically, and they are created only for the type of journals that are related to contacts, so sales and purchases. There's a little bit more detail on this screen. I'm not going to go into it all, but if you're reviewing the recording, you can come back and read it in detail later. Let's have a look at it in the system. So we have some customer debt already, this particular customer, and we've cleared their euro balance, but I know they've still got a dollar balance. So let's filter by dollars, go to allocate payment, and this dollar order will have a base component, but we're going to change the exchange rate. We're going to change it quite considerably. We're going to pay it into a bank account, doesn't matter which bank account, and then submit. Close the invoice, just like the previous example, but because I changed the exchange rate, we now have an exchange rate variance journal. So let's filter by invoice reference. The sales invoice here at the bottom is $100, 59.40 sterling. And then the sales receipt, again $100, but 67.11 sterling. So the 771 has to be put on the exchange rate gains and losses account. Now this is chosen on a per currency basis. So if we go into settings and then currencies, you can see that each of your currencies can be set up with a different exchange rate gains and losses account. That's particularly useful for seeing how much money you're gaining or losing due to foreign currency transactions on the profit and loss report. All of my currencies use the same account, but of course feel free to set up different ones there. So there's a question coming in. Is the exchange rate gain or loss journal created automatically? Yes, it is, very much so. So all I did there was I created a sales invoice, and then I created the sales receipt, and then Brightpearl automatically created the exchange rate variance journal. If I was to cancel either of the SI or the SR, it would automatically also cancel the exchange rate variance journal, because the variance next time you cleared the invoice perhaps would be different. Right, that's quick invoices, that's the concepts. What we're now going to do is we're going to move on to foreign currency sales orders and sales credits. Just like before, the order currency is inherited from the customer currency if you're creating the order manually in Brightpearl back office. If you are downloading orders from sales channels, then just as before, the order currency is determined by your sales channel or the sales channel settings. The payment for the order is made in the order's currency, and the accounting entries are in the order's currency. Now this is for new orders. We've got the concept of transition orders or old orders. So for those of you that are using Brightpearl accounting already, you'll know that foreign orders are paid with base currency. So that's the exception to this rule, and I'll come back to those shortly. Quick question from Kate on updating exchange rates. I'll come back to you in a few minutes. So, previously, prior to multi-currency being activated, the currency had a single exchange rate which you could edit. Now Brightpearl has multiple exchange rates, and each exchange rate has got a date and a time. And Brightpearl goes to its own exchange rate system, exchange rate tables, which are living within your account every time you do a foreign currency transaction. It looks for the rate at the time of the date of the transaction. So if you create a new order right now, it'll use the latest rate. If you do a bank transfer yesterday, it'll see what the rate was at yesterday if it's any different from today. So you need to add these manually whenever you want the rate to be updated in Bright Pearl. Some companies negotiate the rate with their suppliers, and maybe once a month they'd want to change that. What we're trying to do is assess how often people want to change their exchange rates and potentially whether the exchange rates are due to be driven by the channel, for example. So we'll come back to that if you've got any questions. Here we can see that a given currency, dollars, has got different rates. First one created at the beginning of time, and then regularly we add new rates. So if I went and did a bank transfer dated at some point in the middle of March, it would use the rate of 3.32 because that was the latest rate at that point in time. Every transaction you make manually, you can change the exchange rate. These exchange rates are most relevant for automatically downloaded sales orders from your channels. So before I go into a demo, I'm just going to mention that the suppliers or the vendors side of things is pretty much exactly the same as sales, apart from the fact that batch purchase invoices require all your orders have the same exchange rate. So that's fairly logical, but it's the only difference between sales and purchases. So let's drop across to the demo and have a look at some sales. I've only got 3 sales on my system to keep it simple, and they're all foreign currency sales. One of these is invoiced, so this middle one here is invoiced but not yet paid, and the top one is not yet invoiced and not paid. The bottom one is one of those transition orders whereby the foreign currency order has got a sterling total because that order was placed and paid before multi-currency was activated. Let's open the second one, and it's a foreign $54 order. Because it's invoiced, I can't change the exchange rate, but what we'll do is we'll just take payment for it. Let's just choose money order. I can choose how much I'm paying. Because it's a dollar order, I'm choosing the amount in dollars. If you were actually receiving money into a base currency bank account and the bank had told you that it was a different amount, then you could do that too. But for the moment, let's just take payment in full. Pretty straightforward. Dollar order, dollar payment, and if we go into the general ledger, a dollar sales receipt. It's just filtered to show all the transactions just for that order. Because the exchange rate was the same on both, hang on a second, that's not the right order. Where are we? Okay, what's happening here is the invoice was made before multi-currency was turned on. So even though I took $54, Bright Pearl is respecting the rule whereby all journals for a given order or invoice have to be in the same currency. So this is another transition order. Hopefully that's clear. What we're going to do now is have a look at an order that is purely operating in multi-currency space. So it was created after multi-currency and nothing has yet been paid. If we invoice this order, we'll get a dollar invoice with the base component. If we go back to the order and take payment, we take payment in dollars just like before. But this time we'll get a dollar journal because the invoice was in dollars. So those exchange rates didn't change. Let's have a look at what happens if we create an order manually in the system. It pulls in our most recent exchange rate, but it does not fix it. Let's just pop some items on the sale. So $120. We can take payment. Let's say we're going to take payment in full at the given rate on the order, which will put 71.28 as the base value of that journal. If, however, we then go and invoice it at a later date that has a different exchange rate, that exchange rate will be automatically updated when you invoice. So let's just represent that by hitting invoice. What I'm trying to demonstrate is the fact that when you invoice an order, the rate is used from the system unless you set fixed rate. So we'll create a new order. And we'll just add some items again. But this time we're going to fix the rate. So that effectively allows us to override it, negotiate something with the customer, negotiate the rate with the supplier. And once that rate has been agreed, when we invoice or when we take payment, that rate is being used, the fixed rate, and you can't edit it. So fixed rate orders are pretty useful for the situation where you're negotiating rates, but they're also used where we're downloading orders from sales channels so that you don't get exchange rate variance journals popping up all over the place that aren't really required. So sorry, that was a little bit confusing. I jumped around a bit, but hopefully the concept of fixed rate versus not fixed rate is clear. If we invoice this order, because it's fixed, Brightpearl will respect that 1.2, and that's what we'll get on the journal. So, what else do we need to look at on sales? I think that's pretty much all. Has anybody got any questions specifically on sales before I move on? So we've got Dan asking, can you pay a euro supplier in euros from your euro account? Yes, of course. Let's do some purchasing. See if I've got a euro supplier. I don't. Who have I got? I've got a dollar supplier, so let's just use that as an example. Here's a dollar supplier. Let's see some items. Let's just pop some of those on. We're going to buy 10. And we might choose to pay them. I've only got a few payment methods set up. In the real world, of course, you'd have bank accounts and credit cards and so on. And we're giving the choice, or given the choice, of paying in dollars or tweaking the exchange rate to pay a sterling amount. So if we didn't have a dollar bank account, what I'd suggest is quickly get your calculator out and determine how many pounds you want to pay, and then work out the amount of dollars that you need to pay them. So we're going to part pay this purchase order at 134. So we've paid $100, and that's what you'll see on the supplier financial history, but on your base bank account, or the dollar bank account, whichever bank account you chose, you'll see the relevant base quantity there. Let's just go back to this purchase order and receive inventory, because something else that I need to mention is the fact that all assets, in other words inventory, are base currency. So let's just receive that inventory in, and go and see the general ledger, and you can see the PG journal, the purchase goods journal, is purely a base currency journal. Now there's something else I just need to show you before we move into full Q&A, is the bank account revaluation. In fact, there's a couple of things I need to show you. We'll start with bank account revaluation. So over time, money is going to be moving in and out of a bank account with different exchange rates. Because we snapshot the exchange rate at the point of transaction, the current value of that bank account in base is going to be different from the sum of those exchange rates. Let's just actually see what that looks like. So we'll go and have a look at our dollar bank account, which Bright Pearl thinks is 2733, because we go to the general ledger and filter by the dollar bank account, the sum of all these base values adds up to 2733. But actually, when we look at our bank statement and we convert it to today's base currency with today's exchange rate, it might only be saying 2700. So this is how you revalue that and record that exchange rate variance. We go to our dollar bank account and we revalue base currency. So we say that actually today my $5,000 is only worth £2,700. But you might choose to do this once a month. This will post an exchange rate variance journal in a very similar way to the ones that happen automatically when you clear invoices. And you can see here bank account revaluation is putting that $33.99 against the relevant exchange rate gain or loss account for that particular currency. So I'm just going to catch up with a couple of questions. So Stephen is asking, you've already got foreign currency bank accounts. Will you have to replace them with new bank accounts in Bright Pearl? Short answer is yes. The long answer is how. Watch the next webinar, which is transitioning to Bright Pearl multi-currency. Or in fact, there's also a PDF guide which you can have a look at on our multi-currency landing page. And the link for that is at the end of this webinar. So Kate is asking, moving to Bright Pearl from 1st of January. And again, this is a transition question. Will you be able to transfer the foreign balances to the appropriate currency? Yes, you can, and more information on that is in the document I just mentioned or in the next webinar. So Rose is asking how to allocate a payment against a sales invoice. The payment was not allocated at the time of receipt. Absolutely. We've covered this briefly, but I might have rushed through it. So we want to allocate payment against a sales invoice. I can reach invoices via age debtors or any number of other ways. Let's also try another one, customer list invoices. These are all the invoices for all customers. So filtering this list to just one customer lets me go to the same allocate payment screens. So let's say we want to take some money for their foreign debt. They've got $24 that they owe us. Allocate payment here. Takes us to the allocate payment screen, which is exactly the same as you've seen before, but it's filtered by currency. And you can change that here. We can receive money into a base currency bank account or a dollar bank account for this dollar transaction. And then choose however much you want to receive. So let's say we're going to pay most of this, or the customer's going to pay most of this. And if we want to define the exchange rate, we'll do so there. So that's how to take foreign or allocate payment against an invoice. So when I say invoice, the invoice is the actual accounting transaction. If you wanted to do it from the sales side of things, you could do it in exactly the same way. Sales, recent sales. Looks like most of these are paid. The one that we've just received $20 against, you can see is only part paid. So we could go into that order and we could take further payment. And we can see that there's only $4 left to pay. So we'll take that payment, which will fully clear the invoice. So there's two ways to clear the payment on that invoice. I'd also like to show you foreign currency unrealized gains and losses. So this is where you've got open foreign currency invoice, uncleared invoices, and the base value of those invoices was captured when the journal was created. Now the exchange rate has changed. That foreign debt is actually worth a different amount to your business. So this report shows you your exposure to foreign currency gains and losses, effectively preempts what the loss might be if you cleared the invoice today. That report is in, I believe it's, here we go, reports, unrealized gains. And because of course I've just cleared all of my invoices, there's nothing to show. So what I'll quickly do is I'll create a new quick invoice for a $1 customer, and we'll say it was made at $1,200. Let's go to the unrealized gains report, and today's exchange rate from our internal exchange rate tables is 16835. So while it was originally valued at 833 because the exchange rate was 1.2, today's value of that $1,000 is only 594. Not a great place to be. So we actually would make a loss of 239 if we were to pay that invoice today at the current rate. And remember that the current rate is the rate from the exchange rates table, which is over here. And that is not updated automatically. So let's have a look. Let's filter to dollars. If I was to add a rate effective from today, that would now be the current rate. So if we go back to the unrealized gains report, you can see at the current rate here, which is a slightly more favorable rate compared to the original, you're making less of a loss. So quickly going to cover another question. Prior to multi-currency, you had to transfer your euro balance to sterling at the month end. I think what you're asking for is how to revalue your foreign currency bank accounts, because when you transition to multi-currency, you'll move all your balances into bank accounts of the same currency. So a euro balance would be in a euro bank account, and then each month you just revalue that. So hopefully I've covered that already. The feature, just as another reminder, is accounting list bank accounts and then revalue base currency. And you can do that at each month end or however often you want to do it. Okay. A couple of times during this webinar, I've shown you that you can actually receive or pay foreign transactions from a base currency bank account. That's completely fine. You can have full multi-currency accounting in Bright Pearl without having real-world foreign currency bank accounts. Many of our merchants do have foreign currency bank accounts for obvious reasons, but it's certainly not a prerequisite. So that's just something that's worth mentioning. Also, something that is important to remember is that management reports are always in base currency. Let's go and have a quick look at these: the profit and loss or income statement, balance sheet, and trial balance. So let's have a peek at, first of all, the profit and loss. This shows the base component of all of your journals. And like I mentioned earlier, the exchange rate gains and losses. So profit and loss is your company profit and loss in your company-based currency. If you wanted to extrapolate information in dollars or in euros and so on, it's a fairly easy job just to export the general ledger and then do what you like with that data. The balance sheet is again a base currency report, as is the trial balance. And drilling down to all of these will give you foreign currency transactions, but also base currency transactions. It's also worth mentioning that there's no sum at the bottom of these columns because the rows are all in different currencies. The base columns, of course, can be summed because they're all in the same currency. So if you wanted to show the sum of a certain column in one currency, so here, for example, debtors control, I could show just my debtors control for dollars. Let's just pop that open and filter. So these are all my dollar debtors, and now because all the rows are the same currency, we've got a sum at the bottom. Okay, so a couple more questions. In the foreign currency sales reporting, will the margin analysis all be in base currency? In fact, questions are starting to pour in now. So what I'll do is keep those questions coming, and I'll just confirm that we've covered everything we need to cover, and then I'll stop the recording. So yeah, we've looked at the fact that you can only see sums at the bottom if all rows are the same. And journal types. So there's only certain journal types that support foreign currencies. The banking journals that we saw at the beginning of the webinar and the contact journals that we saw at the second half of the webinar. Other journals are all in base currency. So that's covered everything I want to cover for this initial webinar. Have a look at our multi-currency landing page, which you'll be able to find on our support docs for all the documentation to download as PDF as well. So thank you for watching. We'll move on to Q&A next.